Abhimanyu in Mahabharata was perhaps better warrior than Arjun, but unfortunately he was killed because he did not know when and how to exit the Chakravyuh. The same analogy can be applied to mutual funds, where most of us understand when and how to enter into the mutual funds, but we do not understand when to exactly exit mutual funds. In this video, I am going to talk about 5 fundamental rules that will tell you when to exit a mutual fund, and I will give you practical live examples. So please do not skip this video, watch it very carefully. And lastly, if you find this video useful, please do not forget to press the like button and follow me. Rule number 1 is, if your mutual fund is giving less returns than the benchmark index fund for the consecutive 4 quarters, that means there is something fundamentally wrong with your mutual fund. It might be that your mutual fund manager is not performing well, or the overall market situation is not conducive to your mutual fund bets that they are placing. It could be n number of reasons. We are not going to go into details of reasons, but rather we would look at the performance and let the numbers talk about it, right? Let me give you a very quick example of that. Point in case you see on my screen is Axis Blue Chip Fund Direct Plan. I've talked about this fund in my previous video as well. If you look at the last 1 year return, you will see that this scheme has given minus 2.55%, which is a loss, while the BSE 100 index has given 2.92%. Overall, roughly 5%, more than 5% less returns is what this fund is giving as compared to its index. Also, I just want to quickly make a point that please make sure, if you are my viewer, you know for each of your mutual fund what is the index or the benchmark index that mutual fund is following. It is very, very important for you to know, right? Now, coming back to this chart, you will see that in the last 1 year, if you look at the performance, blue line is Axis Blue Chip and the orange line is the BSE 100 index, right? We can clearly see here that at least from last 6 months, if we see from November 2020 onwards, there is a very big difference between the performance of the returns between Axis versus orange line, right? Now, please know that this is only point to point returns, and in my videos, I always talk about also consider the rolling returns, right? For that purposes, we are going to look at this website here, and what you will notice that I've taken last 1 year period from last March 2022, when I'm recording this video is in April 2023. And I've taken the monthly rolling returns. You will see here orange line is Axis Blue Chip and blue is the overall large cap equity category, and you will clearly see that except 1 or 2 points, orange line is, for example, here orange line is Axis Blue Chip is performing better than the overall category, and here as well. But other than those 2 points, if you can see last 1 year consistently Axis Blue Chip fund is not performing well, not giving good returns, right? When this happens, you need to consider exiting that mutual fund. Now you will say, Rahul, what do I do with the money? What you can do is, if you want to stick with the large cap mutual fund, you find a better mutual fund that is performing in the last few quarters, right? I've created a separate video on my YouTube channel just few months ago about selecting the best large cap fund that has beaten and will beat index mutual funds. Please go ahead and watch that video. I will put the link in here. Secondly, also do an exercise that go ahead after this video and look at each of your mutual fund and compare the returns between your mutual fund and the index or the benchmark index performance in the last 4 quarters, and let me know in the comments which of your mutual funds are performing better and which are the mutual funds that are not performing good. Rule number 2 is, if your mutual fund's expense ratio has gone up by more than 50% in the last 1 year, that tells you that there is a problem and you need to exit that mutual fund, because higher expense ratio is going to cost you a lot of money, thousands of rupees in the long term, right? So let's take an example. Have a look at the screen. Axis Small Cap Fund Direct Growth. I don't know, you might say that, Rahul, why are you after Axis Small Cap or Axis Fund House? There is no agenda here. I'm simply picking the right example so that I can bring it to life, right? Have a look at this Axis Small Cap Fund Direct. If we go down here, we will be able to quickly look at the expense ratio history. So if we go down and check the past data, you will see that right now, 31st of March, their expense ratio is 0.54%. If we go back to 1 year, so if we go back to March 2022, let us go back to March 2022, and you will see here their expense ratio was 0.35%. So it's gone up from 0.35% to 0.54%. That is more than 54% increase in the expense ratio in the last 1 year. As per this rule, I would consider now looking at alternative investments for my small cap mutual fund. So if I just go, for example, to the other small cap mutual fund categories, let us say in this screen you will say Nippon, SBI, Axis, Kotak, Canara, all are good small cap mutual funds. And if you look at the expense ratio of these, you will see that Axis is giving 0.54% right now. But if you look at Nippon and SBI, they are even higher, right? If you look at Kotak, it is still higher. The only one that is lower than the Axis small cap mutual fund is Canara Robeco, that is giving 0.47%. So now what you need to do is analyze Canara Robeco mutual fund and consider many other factors, not just the expense ratio. Expense ratio is merely a trigger for you to look at other alternative investments. But expense ratio alone cannot make that decision for you, because let me give you an example of this. If you look at this screen here, there are two mutual funds, fund A and B. You invest 10 lakh rupees for 40 years in both the funds. Fund A is giving you 10% return. Fund B is giving you 12% annual returns. And the expense ratio of fund B, of course, is 1.5%, which is higher, but still it is able to give you 5.42 crores, a better corpus than the fund A, although the expense ratio is higher here. My point is simple here, that expense ratio going up by 50% in the last 1 year, it is a trigger point for you to consider other mutual funds in the same category and do a thorough analysis of the potential returns that the new fund is likely to give you versus the existing fund, and make your decision based on that analysis, not only just on the basis of expense ratio. Rule number 3 is the tax liability that you have on your mutual funds on capital gains. This is the least talked about topic, but very, very important when it comes to saving thousands of rupees. So let me quickly explain. Let us take an example. Let us say you invest 10 lakh rupees in an equity mutual fund, and after 10 months you would have gained, let us say 2 lakh rupees of capital gain, which is great. You've done really well. You've got 20% of capital gain in within 10 months because you are very smart. You know how to invest, where to invest, right? Now let us say you want to exit that mutual fund at the 10th month, right? Equity mutual funds, the rules are very simple. If you exit a mutual fund before 1 year, right, you have to pay short-term capital gain, which are taxed at 15% plus 4% SAS, right? So 15% of 2 lakh rupees, which is your capital gain, is 30,000 rupees. So if you decide to exit at the 10th month, you will have to pay 30,000 rupees to government for taxes, right? However, if you decide to stay for 2 more months with the same mutual fund, then after 1 year, for equity mutual funds, you will have to pay only long-term capital gain tax, right? Long-term capital gain, first 1 lakh is exempt from any taxes, and the next 1 lakh rupees will get taxed at 10% capital gain tax. So in this example, if you do not have any other capital gains arising from, let's say, property sales or whatever, if you only have this capital gain 2 lakh rupees, then 1 lakh is exempt from any taxes. And if you hold it for more than 12 months, then you will only pay 10% on this 1 lakh rupees, which is going to be 10,000 rupees. This way you are able to save a lot of tax. Let me know in the comments if you would like me to clarify the taxation part on the various types of mutual funds. It's a very, very important topic. It's a complicated as well, because I'm not a SEBI registered advisor, but I will do my best to do the thorough research and bring back to you the nitty-gritties of the taxation that you will all get benefited. So let me know in the comments if you would like me to shoot that video. Rule number 4 is changes in the government policies that may dictate an exit from a specific mutual fund category or a specific mutual fund for that matter. For example, recently government proposed a changes into the taxation of debt mutual fund categories effective from 1st of April 2023. As a result of this, what is happening is in debt mutual funds, the taxation is now very simple, that whether you hold it for short term or long term, the taxation on capital gain is you have to pay tax as per your income tax slabs. So if you fall under a bracket of 30% income tax, you will have to pay tax as per the 30% on capital gain. While earlier, before 1st of April, what used to happen is for the long-term capital gains, you were only paying 20% after indexation on debt mutual funds or 10% without indexation, which was very, very conducive from a taxation purposes. I don't know why the hell government has actually increased the taxes on debt mutual funds. That has made debt mutual funds slightly less lucrative, and more people are now looking at their alternative options such as fixed deposits and whatnot. So whenever you are investing in mutual funds, please keep an eye on the government policies, especially the taxation part, because you might lose a lot of money because of just taxation. So rule number 4 is taxation or government policies in a broader sense that you need to decide based on government policies. Rule number 5 is changes in your personal circumstances. Very, very, very important. And I'm going to pick up 3 key examples that might be valid for all of us. Number 1 is, let us say you are at the stage of your life where your income is arising, you are able to take more risks now, and you want to now change your investment style slightly. For example, let us say if you look at this here, in the last 1 year, ICICI Prudential Infrastructure Fund, it's a thematic fund that invests in infrastructure stocks, right, has given, let us say, 22.1%. They are highly risky, and normal investors like you and me might not be able to take that risk of fluctuations in such mutual funds. But now you are at a stage where you want to take more risks in your portfolio, and you say, okay, actually I've never invested in thematic mutual funds, and an infrastructure fund, for example, here is giving 22.1% in the last 1 year. I want to explore this particular type of mutual fund category. While Nifty has only given me in the last 1 year 4.15%, I would like to now rebalance my portfolio and move out of, let's say, large cap mutual funds or index funds, and I want to start, investing money in my infrastructure funds, for example. By the way, this is just a very sample mutual fund that I've given as an example. Please do not take this as any recommendation, right? So therefore, you might want to exit from your index mutual fund or large cap mutual fund and put that money into any infrastructure mutual fund that you have done the research on, right? So that is example number 1. Example number 2 is, let us say in the last 1 year, home loan rates have gone up drastically high. I think right now it might be around 8.5 to 9%. Let me know in the comments how much of home loan rates you are paying, but it's gone crazy, right? Now you might say, actually in the last 1 year, Nifty is only given me 4.5%. It's a high inflation right now in the economy. Repo rate is increasing every quarter almost. Home loan rates are going up. Why don't I take some of my money from mutual funds and prepay my home loan first? By the way, I've created a separate video. It's not that simple that you just take the money out and put it in your home loan. There are other factors to be considered: when to repay, when not to repay. I will link that video in this video as well. You can watch it. But my point is simple. You might need to reallocate your money to home loan repayments in this example, because stock market is not performing well, and the next quarter or 6 months or 1 year, it is not likely to give you higher returns, while your home loan rates are 9%. Get rid of home loan fast, right? So that is the second example I wanted. Example number 3 is the emergency fund. So sometimes all of us might have emergencies at home, and our emergency fund might not be sufficient enough. What do? We withdraw the money from mutual funds. I know it is not right financially, but sometimes we have to take those calls in our life because we are dealing with an emergency, and our emergency fund, for whatever reason, is not good enough right now. We need to exit. Like this, there may be a number of personal circumstances. On emergency funds, I've created a full video on my YouTube channel. Please go and watch it. I will link it again here. And lastly, you might be going through some personal circumstances right now. Let me know in the comments if there is something that you are willing to share. I'll be reading as many comments as possible and would like to reply to as many as possible. And if I'm able to add value, I'll be really, really happy. So these are the total 5 rules that I've talked about in this video in terms of when to exit mutual funds. If you found this useful, please press the like button, and you can follow me for upcoming videos. Keep rocking.